Hi, nice to see you. I'm just going to give it a couple minutes to see if we've got anybody else joining us. We had a lot of people sign up to this, but not so many turning up live. I guess it's that thing. It's school holidays, isn't it? And people want to get the replay. I'm assuming. Plus, I think it's going to be a great resource to refer back to. So to have the replay is going to be a great thing to have. Um, Thanks everyone for giving up your lunch time. I know this is going to be a valuable one. There's a few people already said to me how excited they are for this. And it's just that sort of top level reassurance because I think a lot of us can do our own self-assessment. I certainly did, but it was always with trepidation. So, um, I'm going to do a very quick introduction to Darren, who's my new accountant actually, and really pleased to say that he's now part of our team, and I love having the reassurance of somebody who knows what they're doing and totally got our back in advance. So thank you, Darren, for that. And also thank you for agreeing to do this for our community. As I say, very much needed. But what I'm going to do is hand over to you, Darren, so that you can introduce yourself far better than I can.
Yeah, no problem. Yeah, thank you very much, Paula. Appreciate you offering this out to me because I've not done anything like this before in terms of teaching. So please bear with me if I stumble along at times, but I've prepared myself with a presentation for everyone. So I'll also share that at the end with Paula to then send out to everyone that's on this call. Yeah, so I'm Darren. I'm an accountant. I trained in practice. Oh God, was it 18 years ago now? I started my career on an apprenticeship. Did the AAT, which a lot of people might be familiar with, and then I moved on to ACCA once I'd completed that. Qualified then once I'd moved into industry. So I worked in-house for various businesses then for sort of last 10, 11 years in sort of management accountant roles, finance manager, head of finance, quite senior roles towards the end of my corporate career. And I recently took the plunge back into practice full time to work for myself and build my own practice up. So I've been doing it still on the side for sort of 5, 6 years, but decided after a redundancy that came up, which was perfect timing for me, that it was the right time for me to dive in head first and do what a lot of you people have done who are on this call and dived into your own thing. So it's a very interesting time, a little bit scary at times, but it's definitely good fun. So yeah, that's pretty much it about me. I've got quite a wide knowledge in terms of accounting. I'm not a master in anything, but I'm knowledgeable in multiple areas because I've been quite lucky that I've worked for so many different types of businesses and in such varied roles. My knowledge goes from personal tax, self-assessments to VAT to corporate tax, to foreign taxes and transfer pricing, group accounting, dealing with larger groups that have ownership in other territories and how that all interlinks. So, yeah, I've got quite a wide experience on my CV, which has been quite interesting for the last sort of 10 years, really. Yeah, so that's it. I'll take a moment to share my screen and then we can move forward with the presentation. So I'll go through a few sort of general bits through the presentation, and then probably about halfway through, I'm going to do a bit of a show and tell. So I've made up a scenario on a fictional person, and then I'll go through actually filling in the tax form to give you a bit more insight. I do it through one specific software. There's many softwares out there, so we'll kind of touch on those bases as well. But it's all pretty much, one is like the other, generally speaking. And it's some of the softwares are better than others at simplifying the process. So yeah, we'll go through that, and then I'll discuss about the tax calculation and then maybe some sort of tax efficiencies that you can consider, whether it's for yourself or whether you're doing this for other clients as well. So I'm looking at this from both angles. Um, And then if we've got a bit of time at the end, do a bit of Q&A. What I would suggest is as we go through, if you have any questions, just pop them into the chat. And then at the end of the session, I can have a revisit on that. And just if there's anything I can answer straight away, I'll go through it. If there's anything I think, oh, even that's not quite my knowledge, I'll go take a look and I'll come back. So we'll kind of tie up the rest of the questions in the next couple of days then and send that across to everyone. Okay, so let me just check that I can share my screen. Right, desktop 2, there we go. Share. Dun, dun, dun. I don't think this is going to let me. Sorry, bear with me one moment. It allows me. Sorry, bear with me. I should have checked for this earlier. There we go.
It says you have permission.
Okay. Right, I think it might let me now. Yeah, great. Okay, desktop 2. So, okay, great. I'm just going to close that. Is that still sharing for you all? Or did that close?
No, can't see it. Can still see you at the moment.
Sorry.
That's it. Yeah.
Okay.
If you make that the full screen.
Yeah. Let me play that.
That's it. Got it.
Great. Okay, fantastic. Sorry about that. Okay, so yeah, mastering self-assessment. I think Paula was a bit too kind to refer to it as mastering, but I will do my best to give my 18 years of knowledge on self-assessments over to people. So yeah, this was just a bit of blurb about me. Obviously, we've gone through that, so I'll skip this page. Right, so what is self-assessment? So I'm just going to, I've got the annoying little thing in the way, so I'm going to move that. Yeah, so what is self-assessment and who needs to complete it? So self-assessment, it's an official system from HMRC for an individual to just report and pay their taxes that are due, and obviously report their income. So if you have income that is outside of PAYE employment, it's basically the system to do that for them to capture it and ensure that you're paying the correct taxes. And then who needs to do it? So this isn't an exhaustive list, but it's the sort of general consensus. So anyone that is self-employed with gross income exceeding the trading allowance of £1,000 per year, partners of a business partnership, so same as self-employed really. However, just to note on partnerships, they also have to complete an additional self-assessment called an SA 800 for the actual partnership itself. So if you have a partnership of 2 people, the 2 people will do a self-assessment each, but also the partnership does a sort of third self-assessment. Individuals with property income exceeding £1,000 per year as well. So again, like self-employed people, you get that trading allowance for rental income. Individuals that have made capital gain on disposal of an asset. So the prime example here is a second property. I don't know if anyone on here has second properties that they rent out that might dispose of it in the future. It's actually not just reported on a self-assessment for property disposal. There is a 60-day limit to actually declare the initial gain. So just something to be mindful of if you decide to dispose of a second property. Within 60 days, you need to notify HMRC and pay the estimated tax over. So the reason I say estimated tax is because it might be partway through a tax year. You don't know what your earnings are going to be by the end of that tax year. If you're employed, you're going to have a very good guess, but if you're self-employed, then that could fluctuate throughout the year. So you base it on what you expect to earn, and therefore HMRC will determine whether you're paying the tax at the basic tax rate band or a higher tax rate band. And then on your self-assessment, you would finalise those figures along with the rest of your income, and any overpayment or underpayment will be corrected at that point. Individuals that receive an untaxed income, so savings interest that goes above the tax-free thresholds, dividends from shares, whether that's your own limited company or whether you've invested in shares elsewhere and received dividends, commissions, tips, foreign income. So pretty much anything that you don't get taxed at source. If it's a taxable income, then you most likely need to fill in a self-assessment to declare that. And then the final one to touch on is individuals that need to pay the high income child benefit charge. So if you earn over £60,000 per year and you get child benefit, that then tapers down. So you might need to pay a charge on that. So when doing self-assessment, I always look at it from a client perspective because it's generally, the self-assessments I'm doing are for other people. So you can incorporate this into your own self-assessment too, and think about what information do I need to gather, what checklists should I complete just to make sure that I don't miss anything. If you file your tax return and it's wrong, and it is something that HMRC already have information on, they quite often just go and change the return and they inform you, we noticed a small error in your return, you forgot to declare, I don't know, benefits in kind, the P11D. We've adjusted that. Here's your new tax calculation. There might be no further action needed. Sometimes they then turn and say, please, can you resubmit? But in most circumstances, they tend to go, we've adjusted it. If you agree with it, you don't need to do anything, just pay any due taxes. But if you disagree with it, please let us know within 30 days or something. So yeah, just gather the right information, just make sure that you've kind of sense checked everything. So, there's little things that pop up and you go, oh God, I didn't even think about that. They're easily missed. So these things vary. So obviously things like your sole trader accounts, your employment income, P60, P45, any P11Ds, pension income if you receive state pension or private pensions, rental income, dividends, capital gains income, taxes you've already paid. They're obviously quite important in this because you don't want to overpay tax. So you might be in a position where you've already overpaid, and when you fill in your self-assessment, you may be due a rebate. So another one for anyone that does have clients, maybe in the construction world, they would be getting tax deducted on CIS basis. So if they are contracting with another contractor, another company, they will be having tax deducted at source, very similar to PAYE. Interest on your savings accounts that are outside of ISAs. Private pension contributions. So this is important if you are hitting that higher rate tax bracket of 40% and above, because any private pension contributions that you make outside of an employment pension could generate, some tax efficiencies for you. So we'll touch on that particular detail a little bit further on in this presentation. I've done a bit of an illustration to show the benefit of doing that for someone who's earning, say, around £80,000 a year, whether they pay into their pension or not. And gift aid donations, very similar to your pension contributions, they can also increase your basic rate tax band. So it's, if you give regular donations to charity where you take a little gift aid box for them to gross it up by 20%, they are relevant for your tax return as well. Student loans. So this is one that quite often gets missed. People forget to mention they have a student loan, especially, if they've not got any employment and they're just a sole trader. When you do your tax return, if you are, obviously breach those brackets for repaying the student loan, that does get done through your self-assessment. And then you just need to understand whether you're on plan 1, 2, or 4. Tax code notices, again, these can be quite significant on a tax return. So if you are employed and you've had a tax code update for the current tax year, where HMRC say you actually owe money for a previous year, so we've deducted this out of your tax code and you'll repay it, then it's important to add that to your tax return. Again, it might be that it stops you overpaying tax, or it could be that you might be under declaring then, depending on how your tax code notice is being formulated. So again, they're just quite important to have as extra information to ensure the accuracy when you complete it, so that there's no surprises if anything gets changed later. So yeah, I then like to send my clients a brief questionnaire at the point of parents draft their tax return. So I'll probably pre-draft it based on the information I already know about that client, and then I'll send them the questionnaire and say, can you just check all these details, make sure that there's nothing I've missed or something you forgot to tell me about, and then provide me with that information if so. So I'll just show you a couple of screen grabs from the system I use for this. I'll hopefully just give you some pointers as well on things to look out for. So yeah, employment income, any P60s, P45s, and then any benefits in kind that might relate to that employment. So that is moving away from P11Ds now with payrolling of benefits, but for the current tax year and the previous tax year, it's still relevant. So if you get a company car or private medical insurance, that sort of stuff. But there's also some reliefs that you might need to claim depending on what trade you're in. Some people have to buy their own tools, maybe electricians, people in trades that work as an employee might still have to buy their own tools for the job, and therefore they'd be able to get some tax relief against those expenses. And it might be protective uniforms and professional fees. So those of us here that pay a professional subscription to maybe AAT, ACCA, those types of governing bodies, they are deductible as an employment expense if they're relevant to your job. So the way the tax relief works, you're basically just reducing your income, very similar to sole trader accounts. If you earn £51,000 a year on employment, but you've spent £1,000 in deductible expenses, you'll be taxed as though your income was 50,000. So you're getting tax relief on that £1,000. Quite important then is any of the companies that you are employed by, are you a director of them? If you are, please let me know which ones, and if you received any dividends as a shareholder as well. So people like myself, I trade through a limited company. When I fill in my tax return, I need to know those details of the dividends there because there's been a slight change in how the self-assessment is completed for 2025-26. Again, I'll touch on that a little bit later as we go through the example. Oh, sorry, let me just go back a page. So rental income, again, we've already obviously touched on this, but it's good to know how many properties are they let jointly, and do you have any mortgages on any of those properties? Because there is obviously relief for mortgage interest. Again, there's been some changes on that in recent years, so I'll touch on that a little bit later. Investment income, so anything from savings accounts, any other investments that you might have, whether it's shares, stocks and shares, cryptocurrency, that sort of stuff. Pension income, any details there, any other capital gains from disposals, any other income that you might think is relevant. You might receive some form of government benefit that you're not sure is taxable. So it's worth just making note of that, or for your client to make note of it and go, I do receive this, can you check, is that relevant? Some things might not be taxable, some things will be. And then any tax allowances. So again, back to the gift aid donations, pension contributions, and things like marriage allowance as well. And then any other relevant information I've just got in this final section here. So that your student loans, child benefit, and then if there's just anything else that you want to discuss. So this is the brief questionnaire I send to my clients, get them to fill it in, and it just gives me a point of reference to know that I'm happy with their tax return or whether I need to get any further information from them. So completing the return. So this is where I'm going to use a scenario. So quick little disclaimer, this is all purely fictional information. This person does not reflect anyone associated with me or with advanced virtual assistants. I've just made the name up and made everything else up as I went along. So, got Jane Smith, and she needs to complete a tax return for 25-26. She's got several sources of income, but also some tax efficiencies to utilise. So we'll go through this line by line. So she's a company director and the sole shareholder. She's got a salary of £40,000 that she pays herself, and she's already paid PAYE of 5486 via a P60. She's got P11D benefits in kind for private medical insurance paid for by her company, £950. She also received £20,000 in dividends from her limited company. She's also got some self-employment income from an extra side business she's decided to set up. Turnover is £20,000. She's got £7,000 worth of expenses. Out of those £7,000, there's some client entertaining costs, which are £250. And then just to make note that she also has some private use on her mobile. So we need to adjust that by 15%, which is currently £500 cost. And finally, she's also got rental income with her husband, which is split 50-50. Total taxable profits of £10,000. Total interest paid on their joint property mortgage was £4,500. Oh, sorry, and lastly, some savings interest as well, which you almost forgot to tell me about, of £1,250. This is outside of cash ISAs. But she's also got some efficiencies that she can utilise here after a successful year. She's contributing £10,000 into her pension. And she also makes regular charitable donations to a registered charity of £100 per month. And she's also already utilised her cash ISA limit of £20,000 in the year. So I'm just going to exit this presentation for a moment, and I'm going to swap over now to Zero. So I use Zero for tax at the moment. It's a great platform. Obviously, I've got several clients on Zero, but you don't actually need a Zero subscription for those clients to fill in their tax return. So if you were doing this for any clients at any point, it's a great one to use because it's really straightforward. The form is simple to use and quite self-explanatory. So I'm going to use this as the example. I've already pre-filled this in, but I'm going to start from scratch now. So I'm just going to drag my PowerPoint notes over here so that I can revisit what income I've made up, and we'll go through it. So let me start by just deleting all these schedules. Okay. Right. So I've already got Jane Smith set up as a client in here. I just put some fake details in. I think I'm missing a UTR number and stuff like that at the moment. I've just made up a date of birth. But you would fill in your general details on your self-assessment, sort of front page details, full name, date of birth, relationship status, national insurance number, current address, date of change if you've recently changed address and HMRC don't know that yet. And then one of the important ones to check is your taxpayer status. So if you live in Wales or Scotland, you would need to select that because they do have powers of their own tax rates. And in Wales, it is the same as England at the moment, but for Scotland, there are different tax brackets and varying rates. If you live in Northern Ireland or England, select the rest of the UK. Then there's just some general front page details. It's just things that the tax office issued it. Some of this is just kind of pre-filled information you don't really need to worry about. Other return information. So if you were claiming a repayment, you'd want to click yes, and you'd want to provide your bank details or select to receive a check. If you're not doing that, you can just untick that box. If you have a tax advisor, but you're still filling your own self-assessment, you can put their details in here so that HMRC are aware of that tax advisor. And then if you've put any provisional figures in, so if you are in a bit of a hurry to do your tax return before a deadline and you're still waiting for some information to finalise that, you could go, well, let's submit a provisional. I know it's somewhere around £10,000 on this particular thing, but I don't know the exact figure. I'll submit a provisional return just so that I don't get a fine for missing the deadline. and you can come back later and resubmit an amended return to remove those provisional figures and put the correct ones in. And you've got your tax code and PAYE notices. So that's this section where I mentioned downloading your latest tax codes. It's quite handy. But there's also this handy option. So for anyone that might be employed only and has, say, rental income, they might opt to pay that tax in advance through PAYE and say, actually, I'm going to owe tax again next year because my rental income is not going to change and the expenses will remain pretty flat. Let's just start paying it now through PAYE so that when you get to do your tax return the following year, ideally you won't really owe anything, maybe a small balance, but it just kind of spreads that cost through. So it is an option if you pay tax through PAYE. Payments on account, we'll come back to this bit later. I have got a separate section on this, so we'll discuss that later. And then just any additional notes and attachments that you want to put through on the tax return to support anything. And then you would have your computation summary. So we'll build that up now as we go. So I'm going to work through the example and go through each section. So we'll go with the employment income first. I always like to start with this one. So you would add the employment. If you've got several employments, you can add another new employment, so you can list them out. So we're just going to make this up as we go. So we're going to go ABC Limited, P120, X. No, it's not a foreign reference. This is just an optional thing. I usually tick yes to include it. If you've started employment in the tax year, it's worth adding in the start date, or if you ended it in that year, put the end date in. So we're just going to assume that this one is an ongoing employment for her limited company. She's a director of the company, yes, and she still is, so no date to put in. And is it a close company? So a close company is one that is controlled by 5 shareholders or fewer, or by all its directors, no matter how many shareholders. So in this case, it's a single director and shareholder limited company, so it's a yes. Now this is where I was touching on the importance of understanding dividends received from those close companies. So all directors now, even if you have no employment income from that company, but you receive dividends, now need to provide this information as an added bit of information. This section here doesn't affect the actual tax calculation. It's just for informational purposes, but HMRC are imposing £60 fines, I think up to 3 fines, presumably 1 for each box, for having not completed it. So we'll put in a company number. We know that it was £20,000 that she received, and we know she's the 100% shareholder. And then this is just to do with any work arrangements that are inside IR35. So that is not the case in this scenario we've done. I want to try and keep it sort of simple with a few complexities just to give you all a good overview. So employment income, she's got £40,000. Tax taken off was 486. So as you can see at the moment, tax calculated is 0 due because she's paid her normal tax at PAYE. But we know she's got benefits in kind. So her P11D of £950 for private medical insurance. We populate that here. And then that is it for her employment income. So we've got that information from her P60, and we can just go back. So as it currently stands, we can see that she's been undertaxed by £190 in her employment because of the P11D situation. So the next one I'm going to do is the dividends, as it all relates to this particular company. So UK dividends. So we're going to select this section here, UK company dividends, ABC Limited. Don't need to fill in the description. It's only for your internal purposes. Same for the holding, but I do like to do the holding just for my own knowledge. If I've got, maybe several directors on one company with, multiple shares, I will fill that in just for my own understanding. And payment date, I'm just going to assume that it was on the 5th of April, end of the tax year, £20,000. And now we can see that we've generated some more tax payable. So we'll go back to the summary and we'll add a new schedule for the next bit of income, which is the sole trader income. Sorry, self-employment. So if you have several trades under self-employment, again, you can split them out through this system, so that you can just ensure that you've got the right allocated expenses against the right businesses. But in this case, it's just the one. So let's keep it simple. We're going to call this Jane Retail, online retail business. So provide a description of the business, first line of the address. I'm not going to fill that in for now because I don't have any details for it on that, but you would just complete those details about your trading address. I'm going to say that the business actually started partway through the year, just for the sake of this. 1st of September. It hasn't ceased. No details changed. The foster or shared lives carer is a no. And then the accounting period date. So we've got 1st of September as the start date. And we're going to do our books up to the 31st of March. So then going forward, it will be 1st of April to the 31st of March every year. We're going to use cash accounting on this. You can use traditional accounting, so you could select no if you prefer to do your accruals and prepayments, that sort of stuff. But if you generally work on what you've physically paid or been paid, you can do that under the cash basis. These are the bits of information not really relevant. And then we're going to fill in the information for this. So we know that her turnover was £20,000. I also know out of the £7,000 expenses, £250 was client entertaining, which I've pulled out specifically. Yeah, £250 because client entertaining is not tax deductible. So you can put it through the business as an expense. So, let's think of a limited company for a moment. You can still claim it as an expense against profit. It doesn't need to go down as a director's loan or drawings, depending on what business setup you're in, but you can't deduct it for tax. So we're going to go, we know 100% of it is non-deductible. So you can do that here, the disallowable section. I'm now going to move on to the phone. So we had £500 of mobile phone and there was 15% private use. So I'm going to disallow 15%. So just calculate it for us. So we know we've got £325 of disallowable expenses. I'm going to say cost of goods sold for the business was £6,000. And then the last £250, I'm just going to put the professional fees or something. So now we've filled in the expenses. One of the things with this, if your turnover is below 90,000, you can opt to show HMRC just one figure so that they don't see the breakdown of those expenses. I think if you're maybe unsure on where to categorize things and you don't want HMRC questioning things for no real reason, you can just opt to report it as simplified expenses. So they would just see deductible expenses. You've still got the breakdown here that it might be that you're really unsure on something. You've just got other business expenses, £10,000, but then the following year it's £2,000. It kind of looks odd if expenses jump quite significantly in certain categories. So it is the beauty of being below £90,000. You can use the simplified reporting. So we're going to tick yes on this just for the sake of it, because we can. If there was any fixed assets that she bought, so let's say computers, it kind of depends on the value or how you want to treat your fixed assets. Obviously, you have your own internal decisions on that. I've got a MacBook here. MacBooks are generally £1,500 plus. I use capital allowances for that because I know I'm going to have it for sort of 3-4 years. I don't want the cost of it to hit my P&L in one go, so I'm going to depreciate it over its useful life. And therefore, capital expenses you use capital allowances. So for most plant and machinery, you know, most small businesses are going to be absolutely fine just using annual investment allowance. So if I bought a MacBook for £1,500, I would put that in here and claim it in the first year for full value. If you were in a loss situation, you might opt to not claim any capital allowances and save them for future years. So then you would start using written down allowance value. So you would write down that asset at 18% year on year then, and that would just go into your capital allowances for the main pool and equipment. Another thing just to be wary of as well is vehicles. So vehicles that are not a van, or don't meet certain emission levels have to go through the special rate pool, which is at 6%. So it's not great. You know, say taxi drivers have a diesel car that spits out 150 grams per kilometre. They're not going to be able to claim the full value of that car in 1 year. They're only going to be able to claim 6% year on year for that as a deductible expense. If, however, they went, I'm buying an electric car, so there's zero emissions, you can then put that through and you would get the full allowance on a zero emissions car in 1 year if you opted to. So yeah, that's just a bit of brief information on capital allowances. So we've got nothing to add to that. We're going to go back here. We're happy. We've put in self-employment. We've got a taxable profit now of 13,325, and that's because of those add backs that we've had to do for disallowable expenses. Right. Next thing, rental income. UK property. So the information that we've got on this is that it's split 50-50 with her husband. And all I've done for this purpose is actually put the total in here of profit. So I'm just going to make things up a little bit as we go on this. So we're going to assume like the turnover and stuff like that on rental income. So I'm just going to call this property one. You'd put the address in of the property. Is it let jointly? Yes, it is. And it's one property. I'm not claiming rent a room relief, and it hasn't ceased in the year. So I'm going to say that there was £14,000 of rental income, but because it's only 50% for her, you would only declare the 50%, so £7,000. And then we've got our other costs. So I need another £2,000 of costs. So let's just say insurance and stuff is 500, repairs and maintenance was 1,000, and other costs of services 500. So now we've got £5,000 of rental profit to declare. Now we've also got a mortgage on that property, where interest has been paid throughout the year of £4,500. Again, that mortgage is in a joint name, so it's 50-50 on this unless declared otherwise. So there are instances where, you know, for a man and wife, it might make sense for, you know, one person to declare a higher percentage of rental income than the other. You can opt to do that with HMRC, but you do have to get written authority for that first, even if the property is let, is owned jointly. So it's always assumed it's 50-50 if they're jointly owned, unless the ownership does actually determine otherwise. But you can opt for the rental income to sit in just one person's name because it might be more tax efficient. So there are a few things to kind of consider. So it's this residential finance costs. So 10 years ago, roughly, maybe a little bit longer now, you used to just be able to declare the mortgage interest as a deductible expense off rental income. So if you were a 40% taxpayer and you had rental income of £10,000, you were going to pay £4,000 in tax on that rental income. But with the mortgage, let's say it was going to be £2,000 because you had £2,000 of interest, then you'd be paying 40% on the £2,000 profit. On £8,000 profit. Get my profit numbers mixed up. Now that's changed. You wouldn't get the 40% relief. So residential finance costs, you only get 20% relief. It's capped. So it's something that was brought in several years ago um, to, I presume, to try and make tax fairer. I'm not sure. I have my disagreements with it. Not that I have rental income, but I think it's a little unfair to restrict that on the mortgage side. But that's what we're living with at the moment. You have, say, £1,000 of uh, mortgage interest on that residential property, you will only get 20% relief against that. So you will only get a £200 deduction in tax. You will not get 400 if you're a 40% taxpayer, or 450 if you're a 45% taxpayer. We're going to put this in here, 275. I'm sorry, 2250, 50% of the £4,500. So you can see now the tax due has come down the top. Okay, so next was some of our other bits. Oh, sorry, one more bit of income. Interest. Our interest income. UK interest. Again, this has changed in the last, well, I'd say probably 15 years now. I'm probably a lot older than I realise. And interest used to be paid net of tax through most banks. They would, some of you probably remember this, that you would get 20% deducted at source by the bank. And then, obviously, if you're a higher cent payer, you would still have to pay more, but you might get it back through your tax adjustments at year end. Now it's paid gross. So, sorry, I filled in the wrong one here. Here we go. So, gross interest. And Jane has £1,250 of gross interest paid by Barclays Bank. So we've added that in. And now we're going to go through the tax relief that she gets. So before I go through the additional bits of information that will affect this, we'll have a quick look at the computation. And we'll go through this now. So I'm just going to check this against my... So yeah, this reflects what I've done previously. Great. So in the tax calculation, this is the SA302 equivalent that HMRC can send out to you, which people often need for mortgages and stuff. So the first section, this is your actual income. So it's just summarizing your income, and I would do a check on this, make sure I've got everything there. Your employment, your benefits in kind, your self-employment, your rental, interest, dividends, etc. And you've got your total income, less your personal allowance, and then you've got your taxable income. Then we've got the tax calculation. So this is split into three sections. So you've got your pay, pensions, profits, etc. You've got your savings, interest from banks and building societies, and then you've got your dividends. So the reason there's those three sections is A, there are different rates and allowances, but also it's the use of the personal allowance. So if you only earned £15,000 in the year and half of that was from dividends, you would use your personal allowance against your employment income first, or self-employment, and then whatever's left of your personal allowance gets used against the dividends. It wouldn't go the other way, so it doesn't get used against the dividends first. So it goes in an order, which is why also the tax is calculated in an order. So it determines then what income gets pushed into those 40% tax brackets and so on. So we'll see that in a moment when we do the tax reliefs. But yeah, we can see here at the moment she's a 40% taxpayer. So a basic rate band of 20% higher rate. So this is on her pay and pensions and self-employment income. Then we've got savings. So you do have 0% on the starting rate, but she's not eligible for that because she's paying 40% tax. Then she's got a higher rate band at nil. So the lower rate band is £1,000, higher rate is 500. So she gets £500 tax free, and then she's paying 40% on what's above that. And then finally the dividends, you get £500 tax free, 0%, and then she's straight into the higher rate with her dividends. Um, quick note as well for 26, 27 is dividends are going up by 2% as well. So they are becoming less and less tax efficient. So then we've got our total income tax charge for the year. We've got our relief for the mortgage costs, so 20% of the 2250. That comes off. So then we've got our income tax after those reductions. And then we've got national insurance. So national insurance, obviously you pay class one national insurance on your employment income. However, that does not affect whether you pay national insurance then on self-employment. So you have two national insurance allowances, so to speak. So you've got your class one allowance of £12,570 per year. But then for self-employment profits, you also have the same thing. So as you can see on here, only £755 of those profits are national insurance deductible. And that's at 6% on sole traders at the moment. So being a sole trader is actually quite tax efficient at the current stage. And then it used to be class two national insurance. That's now a voluntary contribution only. So it's for people that have profits below around £7,000 per year, where they're not earning enough to be seen as contributing to the system, that they can opt to pay class two national insurance to ensure that they can still receive state benefits. Things like maternity pay, sick pay for the self-employed that otherwise might not get those things. So that's just something to be mindful of if you have low profits. And finally, we've got a total tax and national insurance. Then we deduct any tax that we've already paid. So she's already paid tax through a PAYE. That's the only tax she's paid through the year before we have a tax bill. So let's now look at her allowances. I say allowances, her tax efficiencies that she's utilising. So she has decided to pay into a pension. So this will be the big change. So we look for pension contributions to a registered scheme. So, for example, they would give you a statement, or you print out your own statement just to check it for that year. So let's say that's from Scottish Widows. And she's paid in £10,000 through the year. Pension contributions that are paid in that manner are grossed up by the government. So you receive a 20% credit, 25% of the net. So you would calculate the 20% on the gross. So her pension's actually increased by £12,500. But now what we can see is her tax bill has significantly reduced by £2,500 roughly. So it's actually only really cost her £7,500 to pay into that pension, because she would have paid more tax otherwise. So to outlay £10,000 cash was actually only cost her £7,500 cash because the tax bill is reduced. And on top of that, she's increased her pension by £12,500 in cash, and then hopefully that grows. So that's why pension contributions are a very tax efficient thing to do. I'll just add in the gift aid as well. So this has the same effect. Gifts to charities. So I'm going to say one of my favourite charities, the Dogs Trust, and she's paying £100 a month in, so £1,200 for the year. That's regular. And again, tax bills come down a little bit. So we'll go back now to the tax computation to explain how that's worked. So, top section, exactly the same. Personal allowance is no different. Income on which tax is due is no different. However, this is the sort of main note to really pay attention to here. So because she's paid £10,000 in, that gross amount of £12,500 can now be added to the basic tax rate band. So instead of paying 20% on earnings up to 37,700, I think it is, after your personal allowance, it's now increased by £12,500. So she's now able to basically all her pay and self-employment earnings are at basic rate band. So we've bumped up the tax bracket. Savings interest, same thing has happened. So she's now only paying 20% tax on her taxable savings. And then finally, dividends, as we can see here, some of the dividends have now actually fallen into the basic rate as well. So this is where those tax efficiencies have really come into play, that now not all of her dividends are at the higher rate, and none of her self-employment is at that higher rate, and her rental income. So she's really benefited quite a lot here. And we can see that in that tax bill coming down from £12,500 right down to £9,300. So that's where pension contributions are really tax efficient. If you are on the cusp of 40% tax, that's where you should really start to consider, should I just pay a little extra into my pension? Because if I do go over it this year, actually I might avoid going into 40% tax by, it might only be £1,000 that you need to pay in to do that. But it's something just to keep an eye on if you are hovering on that 40% tax bracket, or if you're significantly high into that 40% tax bracket and you think, a lot of my money's just going into a savings account that's earning interest, great, but I'm paying tax on some of that interest because maybe I've utilized ISAs, or I don't want an ISA. I'm happy with just, easy access savings. Do I really need all that going in there? Maybe I could pay it into a pension. So it's just one of those things to really consider. And obviously with good pension schemes, you'll get that growth out of them. They're generally pretty good in some of those large companies. I can't give direct advice on pensions specifically. I'm not authorized to, but there's some good schemes out there. I've had some great returns on a few of my pensions that I've played about with over the last few years, and the growth has been phenomenal. So it's definitely something worth exploring. So that's it. I'm going to move back over to the presentation and continue. I know we're about to run a little bit over, so apologies. I will try and speed up a little bit. And as I say, the presentation will be sent across as well for everyone in the next day or two so that they can review it again. Sorry, I've skipped right back to the beginning here, annoyingly. Where did we get to? Yeah, here. Yeah, so we've done that. On here, I've just took a few screenshots of the schedules. So it was in case I didn't get a chance to do a working example, but these are basically the bits that I filled in previous to actually doing the one we've just done. Chuck these in here for your reference to be able to see what sections are being completed and what information is going in. So these are just brief extracts, interest, dividends, profit on rental properties. There we go. So back with tax calculation. So I would do my sense check, as I explained before, just check that you've got all your income. One thing to note is personal allowance. It does reduce if your income is in excess of £100,000. So when you hit that £100,000, for every £2 over 100,000, you lose £1 of your personal allowance. So by the time you're in 126,000, you have no personal allowance to use. Then again, just double check then through the actual income on which tax is due, tax bands and the reliefs that you're getting to your personal pension contributions. And then check the tax calculation, just make sure you're happy with how that is. If anything looks odd, you can just go back and go, oh God, have I filled that incorrectly? There's something wrong in that. And national insurance, again, this class 2 voluntary thing. So again, something to be aware of if you have low profits. So its threshold is 6,845 for 2026. 2027, I think it's 713 or something around them lines, about 7,100 top of my head. Class 1 national insurance is purely employment only, so you don't need to actually fill anything in on your self-assessment for class 1 national insurance. Then finally, your tax due, whether you owe tax or whether you're owed tax. So if you owe tax in your tax return, you need to pay that by 31st of January after the tax year end. So yeah, there's just a few Snips from the self-assessment. We've been through the example if she didn't or did have pension contributions. Right. So just a couple of notes on common tax relief and deductible expenses. So for self-employment, expenses can be deducted if they are wholly and exclusively for business purposes. So such as direct costs associated with your trade, travel and motor expenses, office expenses, including mobile phone, computer costs. Use of own home as an office is obviously another one for a lot of us that work remotely. You can use HMRC's flat rates, or if you believe that they're not fair, you can actually do a detailed calculation on that, where you take into account any rent that you pay or mortgage interest, utility bills, internet, home phone, all the bills of running your house, and then how many rooms that you use in the house and how many hours you spend actually working. So you can do a detailed calculation to get a decent percentage to increase that deductible cost. And yeah, I touched on briefly as well for capital allowances, so just something to be aware of if you have a company van or plant and machinery for a certain business that you might do. Or as I say, taxi drivers, they may own their car and claim the whole cost, but as I say, it depends on factors such as emissions, the vehicle class, and the private usage amount as well. Employment, there might be travel mileage expenses you've not been reimbursed for. So, brief example there. I've worked for employers before that only paid 25p per mile for mileage, but the rate at the time was 45p for HMRC approved rates. So you can claim tax relief on the 20 pence difference you've not been paid, and you would treat that as an expense against your employment. So there might be £2,000 of expenses you've missed out on, so you can get tax relief against that. Yeah, tools and stuff for people like mechanics or construction workers. Rental income, so very similar to your self-employment. It's stuff that is relevant to that service. But just be careful with expenses relating to repairs and refurbishments. So this is where some people can get tripped up on. You might have a roof leaking, you need to repair that, and it costs £3,000. Yeah, great, that's repairs and maintenance because it's just something that has to be done to make that livable. If, however, you've got a rental property and you go, I'm going to put a new kitchen in before my new tenant. It's not that I'm just replacing some broken things. I'm just upgrading. That's capital spend on that property. So you can then only claim that as a deductible cost against any capital gain. So it's just being mindful of those things when it comes to your repairs and maintenance and improvements that you make. Like general decorating, fine, but then anything that's seen as an improvement to the house, like new bathrooms, maybe you're putting oak floor in, that sort of stuff. That's where you've got to be careful on whether you claim it against rental income or consider it for that capital cost further down the line if you come to sell it. And then obviously we've touched on the mortgage interest as well, and that relief only being at 20%. And then other tax reliefs, again, we've already talked about them. It's your pension contributions, your gift aid contributions, how that increases your basic rate tax band. Final checks that I do. So once you've reviewed your tax calculation, a few final checks to go through. So my starting point is just make sure you've got the correct UTR number, correct national insurance number, name, address, contact details are all correct. Taxpayer status, so the residency thing, if you live in Wales or Scotland, or the rest of the UK. Child benefit charge, especially if the gross income is over £60,000, be mindful of that. Is there a rebate due? If there is, make sure you provide the bank details to get that repayment paid a bit quicker. Are there any provisional figures? Tick the box, and then remember to submit a corrected tax return further down the line. Any end dates for ceased self-employment or ceased employments, rental income, because it might be that you're filling in a tax return for 2-3 years and you decide I'm not going to be self-employed after the 1st of January. I'm going to do one more, tax return, and I'm just going to be working on, PAYE employment going, into the future. Make sure you put those cessation dates in, because otherwise the following year HMRC will go, you need to do a tax return again. And if you ignore that letter, you'll end up getting a fine for a late tax return. I've come across a few people that have done that in recent years, and all of a sudden they got £100 penalty in there saying, but I didn't do anything last year, I was employed. So something to be very mindful of. Then back to the PAYE tax coding notices, and are there any adjustments relating to earlier years or current years? Have you already received any tax rebates partway through a year because HMRC have done a predetermination on something, forgetting that you need to do a self-assessment? So it's just little things like that that could just affect that tax due. The final one, some of you have probably come across this, payments on account. This is the dreaded one. Catches a lot of people out the first time that they hit this. So when I've had clients who are quite new to self-employment, maybe they're into their third year of trading and they've only had small tax bills for the first 2 years, then all of a sudden they have a really great year. They come to me with their books, and then I tell them, right, in January you've got £5,000 to pay, and they fall off their chair. So if you've already saved aside your tax, great. Being on top of it, that's always a good start. And getting your tax return prepared early is also another good thing. So yeah, if you pay more than £1,000 in your self-assessment tax bill, and less than 80% of your tax that was due was paid outside of self-assessment, i.e. PAYE, then you need to pay 50% of that current tax bill up front for the latest tax year that we're kind of just into now. So if we have a tax bill of £10,000 for 25-26 tax year that is due on the 31st of January next year, it would look like this. So you have tax payable, £10,000, but then HMRC say, well, by the time you pay that, we're nearly at the end of the next tax year. So we want some money up front, please. Please give us 50% of what we expect you to then have to pay the following year, assuming there's no changes. So please pay us another £5,000. Therefore, that 10,000 tax bill you thought you had is actually £15,000 when it comes to it. So it's another reason to get these things done early, especially if you think my profits are high or my rental income's high, I'm hitting some, big tax bills. Be mindful of these payments on account because they can really sting. However, there's more. 31st of July 2027, you then need to pay your second payment on account. So you've paid £15,000 in January, £10,000 is for the tax year that's well and truly gone, £5,000 is for the one you're sat in at the moment. Comes July, just after the end of the tax year, and they go, right, pay us the rest. So here's another £5,000. So as I explained, the idea is that you're paying it sort of in advance for that next tax year. But HMRC are looking at it and going, right, if you earn the same amount next year, your tax bill will probably be about the same, give or take a few minor changes to pension contributions or tax rates that change. You're going to owe about the same amount of money. So just pay it us in advance. And then when you do your tax return, you'll have a balancing figure. That balancing figure might be a refund due to you, or it might be a payment due to HMRC. And then they'll go, right, so then on that following return, just pay us the payment on account now in January and the next July. So after the first year of payments on account, it gets easier because you've had that big sting. And then all of a sudden, if you're consistent year on year, you should just be paying that, say it's £5,000 every 6 months. So that's the idea of it. You can reduce them. So if you fall into payments on account and you think, ooh, this was a freak year, I earned really, really good money. I don't expect it to be anywhere near that next year. I've already taken 3 months off or whatever it is, you've got good reason to know that your tax bill is going to be nowhere near that following year. And you think, right, it's probably going to be more like £2,000. You can reduce those payments on account and just put a reason in there as to why you're doing that. So you can opt to do that. Just be careful on doing it because you think, oh, I just don't want to pay it. And I'll just worry about it when I get the next tax bill and pay it then. If you do that, HMRC will charge you interest for delaying those payments because you should have made those payments on account. So if you reduce the payments on account, you do leave that door open to be charged some interest for not having done so. Two final notes, just outside of the self-assessment, really. MTD. Obviously, this is another topic I believe has come up within the community recently. It's obviously a very hot topic right now as it's gone live. So anyone with gross income, i.e. your turnover, so don't misinterpret that as gross taxable income. It's HMRC don't like to use good terminology a lot of the time, as we all know. So they could have just said if your turnover from self-employment and rental income is over £50,000 in 2024-25, as of April this year, you need to be completing quarterly making tax digital updates and keeping digital accounting records. So the first submission deadline is actually coming up soon on the 7th of August. So, and I've had my first MTD client have his done this week, and I've got a few more to do. The idea of this, it's not to pay tax quarterly, which I was surprised at when they brought it in that you weren't going to start paying your tax quarterly. It's just for HMRC to know what you're potentially going to be earning when it comes to those tax returns. It's good for yourself. So those that have fallen into it, it's not a bad thing. People that are earning, a pretty decent turnover and hopefully good profits, it's good that they're going to have to be a little bit more on top of their books, as clients, because a lot of people do just ignore the money until December comes when they go, oh no, I've got a month now to do my tax return. So it's not a bad thing to have in place. I think the implementation of it could be better, but those thresholds are dropping. So if your 25-26 return, which is due by the end of January, shows £30,000 turnover across self-employment and rental income, then you would trigger it for next April. And then next year, if your turnover is £20,000, it triggers it for April 2028. So it's something to be mindful of if you haven't hit those thresholds yet, but maybe will do in the future. And a final one, I've already touched on a chunk of this actually. The owner-managed businesses, close companies, filling in that dividend section within the employment part. So this is just reiterating that point to make sure that all directorships, for a close company, do declare those dividends if they've had dividends as a shareholder, so that you don't get those £60 penalties. So if you get three of them, it's £180 for just one tax return not being filled correctly, even though it doesn't affect the actual tax that you're declaring, because the dividends are calculated from the dividends section, not the employment section. They are just penalising people for it. And then a final point, not to scare anyone that does run a limited company, but HMRC are in consultation at the moment to do a form of NTD for directors' loan accounts. So they're discussing the potential to require either monthly or quarterly, or hopefully only annual declarations of all transactions in a director's loan account. So nothing's agreed yet, but they are in consultation, speaking to some of the large accounting firms to get their input. The consensus is from the accounting firms that it should just be an annual thing if they're going to push this, and do it with the corp tax return. But we all know what HMRC are like. They have their own ideas. They may throw burdens on people, which is basically just a thing to say to directors of companies, please don't use your business account as a personal bank account. Just keep everything separate, because there are a lot of instances where people treat their business account as a personal account when they're a sole director of the business. So, yeah, apologies, I've ran over by 11 minutes or 12 minutes. So, not bad considering I'm a waffler. So, apologies for that if I've gone on too long on anything. If there's any questions that people have had on any of this, please just let me know. I'm just going to try and stop sharing my screen if I can
There's
work
several
out
in the
Zoom.
chat, Darren.
Oh, is that? Bear
Yeah,
with me.
we've been waiting to, I think there's a few for you to pick up that have come in as we've gone
Okay.
along.
Let me just see if I can find what's going on here with. Where's my meeting? This. Sorry, bear with me. I'm just absolutely confused with.
Yeah, the layout's changed.
Yeah, let me close this. I can't find the stop sharing. Ah, got it. Stop sharing. Ah, great. Sorry.
There we go. Now
Okay.
gallery.
Let's have a look. So let's see if I can answer any of these here and there.
So if I can help,
Okay, so gift
so we
of
start
money.
with, does money you're gifted, like a lump sum from a parent, if they sell a house, count?
So generally, inheritance tax would be dealt with at the point that you deal with solicitors. So you would deal with the inheritance tax using uh, a
Would that
specialist
be
advisor.
relevant?
But
Is that the same if they haven't passed away, if it's just a gift rather than
if
a
it's an early gift, yeah, let me just check because I've not dealt with any inheritance tax before. So it's actually one that has never jumped up. So I might have to just come back later on that one. But let me just check.
Darren, please don't worry too much time. It's quite a niche question. It just kind of popped
Yeah.
out because it's something that we may be facing, and I'm not sure how that affects my self-assessment really. But I
Okay.
can do some research on that, so
So
please don't.
no worries. Well, generally with inheritance tax, it's on the person gifting as opposed to the
Okay.
person receiving. So the inheritance tax burden is generally on the person giving the gift unless they opt to do it the other way. So if someone was opting to say, well, I'll give you this, but you pay any taxes, then there's like a grossing up thing that has to be done as well. So yeah, it's a bit of a specialist area that I'm not great with, unfortunately. But yeah, generally it would be dealt with by the person providing the gift. And obviously things like your lifetime allowance and stuff like that. You know, if anything falls within that, the 7 year rule. There's also like regular gifts where you can, you know, if someone gives you a regular gift, you can receive that tax free as long as it doesn't affect their living standards by giving you that gift. So I have actually had one instance where someone, their dad has a rental property. He doesn't rely on the money from that rental property because he's got a business, and he gifts the money from that rental property to his two kids on a regular basis every month, about £500 a month. That becomes a tax-free receipt for that person as a regular gift.
Okay. Thank you.
Hope that helps.
Cat asks, with relationships that situations, is that only relevant to if you're married?
Sorry, Kat, in what way do you mean? Was
So,
that just the
it
relationship
was more,
status?
yeah, it was more a case of as you were filling things in, like I'm, I sort of have a partner, but I'm technically single. I'm not married, and I've never been married or
Yeah.
divorced.
Sorry.
I don't understand how that can affect tax.
It doesn't. It's an informational thing. So
Okay.
the relationship status that HMRC asks for, it's just understanding your overall status. So there's the drop down on here is single, cohabiting, married or civil partnership, divorced, separated or widowed. So I think it's more just for their information to kind of go. The way it could affect things around investigations. So if you declare very little profit and HMRC see you as living on your own as a single person, they would question how you can afford to live. So whereas if you tick the box to say, well, I'm cohabiting, straight away it puts a green flag to go, oh, it makes a bit more sense. They can afford to live because they're sharing bills with someone.
Okay.
So
Okay.
it's an informational thing that they will probably use with their AI programs that they're starting to roll out a lot more.
Okay. So my situation is I sort of part-time cohabit and part-time, I don't know, live in my house, but also have a lodger and things. I just, but my business is still not very profitable. So is that something that I would have to worry about
I
potentially?
wouldn't worry about it too much. I think this sort of information that goes on the return will probably be utilized by all the AI programs that they're running. So they're starting to look at people by using AI. They're basically given an AI program to look at people's tax returns, go look for anomalies, look for things that
Okay.
look odd, search that person against social media. Are they on extravagant holidays? What's their travel history like? They're using all this, but they're looking for, big fish in that world there, people that are really taking the mick, that are spending hundreds of thousands of pounds on lavish holidays over the years, but
Yeah.
apparently only earn £50,000 in an employment or
Yeah.
something. That's what they're looking for.
Okay.
The marital status thing, I think you can even leave it blank. I don't think it's a mandatory field on the tax return to fill in. So
Okay.
you could just
Okay.
leave it empty.
Okay.
All right.
Yeah.
And
The next one is mine as well,
yeah,
actually.
go ahead, Kat.
Okay.
So I said, you were showing us all that information within Zero, but you see, I use Free Agent at the moment, and I mean, historically, I was employed and had a house, so I just did all of mine by keeping a spreadsheet and then filling it in on the government gateway. But
Yeah.
you've put all the information there through Zero, but is the data the same on the government gateway?
Yeah. So Zero have just done it in a sort of simplified format. So there's other softwares as well that I've used over the years, like Tax Calc and stuff, and a couple of other small ones. I think QuickBooks is another one that has its own tax return function. They're just more user friendly, some of these softwares. The government gateway is basically just filling in the form. What I could do with this is part of sending out the PDF, I could download the tax to return itself so you can see how it's then populated from what we filled in on screen today. If I just reshare my screen very briefly, now that I've figured this out properly. Share. So I can then go and download the actual pack. And then if I open that, so then this is the actual self-assessment form. So as you go through it, you'd be able to see what details have been filled in, what boxes have been ticked. So, the initial boxes, which forms of the self-assessment do you need to fill in? And then it goes through each sub-form. So you've got your income from dividends and interest, anything from pensions, that sort of stuff,
Yeah.
tax reliefs that you've claimed. So this is the actual form and that data has populated into. So
Okay, and this goes straight into the self-assessment on the government gateway.
Yeah. So what this is doing from Zero, it's pre-filled this self-assessment. So this is just obviously a paper copy, and then when I go to submit this at some point, for an actual client, it will go via the government gateway. So it's just that electronic filing.
Okay.
So there are other software platforms out there, but there's no harm doing it through the government gateway. If you're doing your own self-assessment, just continue using the government gateway. There's no point in paying for a software if you don't need it.
Yeah. I mean, I have the free software that comes with Metal, which I'm not sure if a number of us do here, but I'm still figuring it all out. So, and then each year comes around and I'm like, I need to learn it again. Yeah.
No, that's fair. If there's any particular things on that software and you come to do it, feel free to fire them over, and I'd be interested to see it as well because that's a software I've not used. And hopefully I could guide you in the right direction.
Thank you.
All right, no worries.
Thanks, Darren. Lisa asks about private medical insurance. Is that claimable only if it's part of the employment package, or can you claim it if you pay it privately and are a sole trader?
So Yeah, private medical insurance is only an employee benefit, really. So it'd be through a limited company. Because it carries a benefit in kind, you wouldn't be able to claim it against sole trader profits because it's not wholly and exclusively for the business. As a limited company employee or director, it would have that benefit in kind tax. So the company would pay Class 1A national insurance, and you would pay tax on the value of it personally. So 20% or 40%, depending on your tax bracket.
Thank you. Kat asks about pension relief if you're a sole trader with a lower income, offsetting any saving of interest, for example.
So unfortunately, not the pension contribution only really affects the tax side of things when you pick that higher tax bracket. I still don't say, sorry, I don't say to people, don't pay into a pension. I'd still say carry on if you're paying into a pension just for that retirement pot. If you're paying, £10,000 in a year, you're getting it grossed up by the government straight away by £2,500. So I would continue doing it. Unfortunately, you just don't get the higher benefits of it. If you have employment and an employer's pension, it could be worth utilising higher contributions via your employer, especially if you're on a salary sacrifice scheme. That's something I had in my previous role. Every time there was a tax break, when they dropped national insurance down, I went, well, that extra few percent I'm going to put straight into my pension. And it cost me less to do that because the net effect against tax was there. But yeah, the private pension contributions that you do outside of an employment pension, unfortunately, you only get a tax break when you hit 40% tax.
Thank you. And Kat also says that she wanted to opt into national insurance but didn't get the option. Has she missed something?
Oh, okay. Yeah. So obviously I'm using zero as a thing. There is a separate form within the tax return for Class 2 national insurance, where you would then go, yes, I'd like to pay that separately. So it might be the software that you're using, Kat, whether it's hidden away
Last year I just did it on the government gateway, and it asked me if I wanted to, but I couldn't, for some reason I couldn't press yes and it didn't link up. So
okay.
I don't know if maybe that was just something my end, I don't know. But I just wondered if your business makes a loss, because I think I was in a loss state, whether they won't let you still contribute to that.
No, they should, because
Okay.
you're self-employed. If your earnings are below the threshold, you can just opt to pay it. I think if you've had troubles with that, what you could do is you could actually phone HMRC and say, look, I wanted to pay that last year. I'm worried that I'm not eligible for something, or I'm missing out on my state pension contribution now because I've had a year of a loss. Phone up and say, can I pay last year's? They would probably let you sort that out voluntary. But yeah,
I know
sorry.
from being a military spouse, there's an opportunity to go and see where you've got gaps in your national insurance. And if you're a military spouse, that can be overridden because if you're out of the country and not able to work, so the government top that up for you. But there is some way of going in to check where there's gaps in your contributions. Lisa, are you going to say?
Yeah, I was going to say I actually did that. When you go into your HMRC, there's a number of choices, self-assessment being one of them, but you can go in and check your record, and if you pick up a year where you've got missing, it directs you through and you can try and pay it. In my case, I had to contact them because it was, and I think you've got up to 6 years. So every 6 years, that last one will drop off. And I just had to talk to them, and they had to make sure that I understood whether it was worth contributing that or not. And then they gave me details, and I've actually caught that one up. And yes, Paula, with the military one, you get a letter from HR on base. They sign off against the posting dates, and then you get credits on that.
That's right. Thank you, everyone. So Jenny asked, is there a maximum you can pay into a pension? For example, if you wanted to reduce your tax bill, or dump a lump sum in?
Yes, there is. So there is a pension allowance every year, and it's £60,000. I think it's 60, or did they drop it to 40? They were on about dropping it. Let me just double check. Uh, no, £60,000 per year. So yeah, if you're getting towards the end of the tax year and you think, do you know what, I've got a chunk in savings, yeah, I'm going to do that. Yeah, you've got your allowance, but that's across all pensions that you've paid in that year. So you might have an employment pension and the private one that you're paying into. So just be mindful of what ones you've paid into through the year, and just make sure you don't go over that, because there can then be a tax charge for paying too much.
I've not paid into any pension. So since
Okay.
I stopped employment about 2.5 years ago, my first year of trading was very little because I took 9 months off. But this year I've earned significant amounts and I'm terrified.
Right.
And I'm just wondering, can I just dump a lump sum into? I mean, I do have a pension from my last employer, and I've got a couple of other ones that I've had over the years.
Yeah,
I've lived overseas for a long time, so I couldn't pay into a lot. But I now need to play catch up,
yeah. You
both for
can,
pension and national insurance. And I'm terrified about that as well, because they're banging on about class 4 and class 2, and one's like £100 a week and one's £11 a week. And that's
yeah,
scaring me as well. So I'm just like, I need to reduce my tax by as much as humanly possible.
yeah,
Like, can I dump a lump sum in to
yeah.
an existing pension, and
You
how much,
can.
what's the maximum?
So the maximum is £60,000 that
Oh,
you can put into there.
I don't have that much hanging around, but
Okay. But yeah, if you were to not utilize that, you can actually utilize brought forward that you haven't used in a previous year as well. So just double checking this now, 3-year limit. So you can carry forward unused allowance. So let's say you did have £60,000 that you wanted to put in there, and you went, well, actually, I could stretch it to 70. If you didn't use all your allowance in the year before, you could use that allowance brought forward as well for the other £10,000 that you go
who
over.
has a spare 60 grand to dump into a pension?
I wish.
I'm yet to meet them.
But I thought you were
I'm
going to
working on
say,
it.
I thought you were going to say 12,000, you like £1,000 a
Oh,
month.
no.
But
No, I'm afraid not. No, it's £60,000 is the annual cap.
Wouldn't that be
okay.
nice? You know, just ditch that 60 grand lurking around in my account that I don't need.
So basically, if I start to do my tax return and it's looking nasty, I can just think, right, off you go. You can go into a
If
pension and just
if you
bring it right down.
start doing it early, yeah. If you do it, let's say start to look at what you've earned by the beginning of March, so that you've got a month then to pay something in, because you can't pay them retrospective. The day that it goes in is the day that it's allocated for tax purposes. So you couldn't go do your tax return in May and go, oh God, my bill's 10 grand. I want to reduce it. I can go put 5 grand into a pension. Too late. You've got to do it prior to the year end.
So we're still in the 25-26 period now. So could I dump in?
25-26 is gone. 6th of April. So you'd
What have
only
I
be able
not
to do
done?
it. So 25-26 passed on the 5th of
Oh
April this
yeah.
year.
No, I've done that. I've done that.
But 26-27, because we're in that, you could plan now through this year and go, okay, I'm having a really good year. I'll start making some contributions. And then maybe in March, you go, what's my profit looking like? Shit, I've made 70 grand. Right, sorry, excuse my language. I've made 70 grand. I'm going to put 10 of it into a pension to bring my tax bracket up a bit more.
Okay.
All right.
At least I think I've filed my 25-26. I must
Oh,
have
you got
done.
plenty of time. You got till January for that one.
You've got plenty of time to
25-26.
file it, but you can't do any pension contributions for tax relief purposes
Ah, okay.
for last year.
Really? So you can't play catch up? for last
No,
year, even
you
if,
could play catch up in future years. So you could go, well, I didn't use last year's allowance, so I can use it this year, but you can't go and retrospectively pay it in. You need to have made the payment before the 5th of April.
right. God,
Yeah,
what else can I
sorry.
do?
Run from the tax man.
Honestly, living in Dubai was just, it was so stress-free.
Yeah, I can see why people do it.
Don't know about now though.
Yeah, that's
Still
true.
tax-free though.
It's still
They've all
tax
come
free.
back now.
So last one from Kat. I'm really aware we've run over, but thank you for your
That's all
extra time, everybody. Clearly, everyone is keen to learn all of these things. When you say obligations for MTD start in, say, 30K for 25, 26, does that mean you start submitting 3 monthly from April 28?
No, April 27. So if your accounts to the 5th of April 2026 show a sole trader turnover of, say, £35,000, then next April you need to start submitting MTDs, so April 2027. And that's when you would register for it. Because basically HMRC have given you then till January next year to file your return. So in January at the latest, they should know if you're eligible for MTD, and you've got a few months left to prepare for it. And then it was the 20K in 26, 27 tax year that is relevant to April 2028.
Great.
Yeah.
Here is Matt.
Mhm.
Oh dear. Well, I don't know about anyone else. I'm exhausted.
My voice is, I don't talk this much usually.
Well, that's the last of the questions. Thank you, Darren, so much. It's really
No
helpful.
problem.
I think a lot of us, worry about, because most of us are like to stick to the rules and want to get it right, and so it's nice to have the knowledge and that reassurance.
Yeah,
So thank you so much.
no worries. I hope I covered everything that kind of falls into people's remits. I wanted to kind of go, obviously there's people like yourself, Paul, that run a limited company. There's people on here that sole traders. People might have rental income. I just wanted to try and cover the main basis without, overdoing the information. Obviously, if there's any other sort of areas that people want to touch on, they're welcome to get in touch and fire a few additional questions over.
And what's the best way to get in touch with you?
You can do it through Slack if people are on Slack, or if they want to do it through an email, or whatever's easier. I can leave some of the contact details on the PDF when I send that over. I'll probably be tomorrow. I'll send that over because I just want to make a few tidy ups on it.
Yeah.
And then I'll fire that over with how to reach me.
Yeah, do that. That's great, because that'll go out with the replay then.
Yeah, great.
Great. Well,
Thank
thanks
you, Darren.
everybody. Nice to see you
Thank you
all.
so much, Darren.
Yeah.
Thank you.
No problem.
Thank you.
Thank you for joining. Appreciate it.
Have a good rest of your
Thank
day,
you.
everyone.
Thanks. Take care, all.
Yeah, bye. Bye.
Bye.